Hello everyone. There aren't many of us yet, but we're just getting started. And today we're starting with the S&P 500 index, which is largely considered an indicator of the state of the global economy. It's a fairly broad index of the American stock market, and we'll be looking at it on monthly candles. Take a look. Here was a drop. This is the dot-com crisis, which started with the collapse of internet companies in 1999 to 2000. This one here is the mortgage crisis, which happened in 2007 to 2009. And this is COVID-19. Essentially, there were 2 months of a massive drop, and then quantitative easing began. Yes, and don't let the index value of 660 confuse you. We're looking at an ETF, a fund based on the S&P 500 index. Why? Because the index itself on the Quantfury platform where we're doing the review is traded as futures and mini contracts. And futures have a trading start date, an expiration date, and only cover a limited portion of the chart. So we're looking at all this using the example of an ETF fund linked to the S&P 500. Multiply by 10 and you get the index value. Well, with a slight margin of error. So, overall we can see that since the mortgage crisis, there haven't been any major corrections globally. The market keeps growing and growing. Now, let's pay attention to a few points. Look right here. Well, not exactly here, but in this area. We had an oversold condition according to the RSI. For all this long period, there was no oversold condition at all, which basically confirms what I said about there being no deep correction. Second point, notice here, the highs are rising, but here the highs are sharply decreasing. This is a divergence. So, against the backdrop of overbought conditions on the RSI and the monthly scale divergence, we saw a very significant correction. What else can we see here? We can see, look, here we have one high, and here is the RSI high. Here we have a higher high, but a lower RSI high. What did we see? A correction that lasted 4 months or 3 months. It was a local correction. What do we observe next? We clearly observe a significantly higher price high, but simultaneously a noticeably lower RSI high when compared to this specific area. Furthermore, there is an even more pronounced higher price high accompanied by an even more distinctly lower RSI high. Or the index value, and right now look, the RSI is practically at the same or even lower level. If we zoom in like this, we'll see that it's at a lower level than the previous high, while the index value high is clearly higher. This is a divergence on the monthly scale. But we have the right to talk about a reversal only when we see a bearish engulfing pattern here. And it always happens against the backdrop of any crisis, any corrective reversal. So far we don't see that here. For now this is still a continuing long, but with the threat of divergence and the risk of a very serious decline. If we take this interval right here, look, our highs are decreasing while the index is rising. RSI highs. That's it, we're deleting everything here. We're saying that there are potentially serious downside risks here, and note that we've already touched the 100-month moving average, which means we could go back to it again. That would be a drop to the 4,000-point level on the S&P 500 index, or maybe even to the 200-month moving average, which is 2,850 points. But it's too early to talk about that for now. There's no bearish engulfing pattern, so we understand the risks, but it's not a short yet. Let's move on to the weekly candles. What do we see on the weekly time frame? On the weekly time frame, we can see that the index has already entered this oversold area. And right now it's in the overheated zone. Take careful note that right here, let me just zoom in and make it significantly larger for better visibility. Right here, we already have a very clear and distinct bearish engulfing pattern that has formed. There was an attempt to retest down to the base of the red candle, which means we have very high risks of a decline, at the very least down to the area of the 50-week moving average, and at most to the area of the 200-week moving average. Why? Because we've already approached it before. So we have some very serious downside risks here, and the key level, the technical support level, this is the consolidation zone. Let's turn on the magnet and take a look. Just like that. So again, a decline seems likely here as well. At the very least, to test the 6,070 to 6,100 point level. Just to see what happens. If it holds, then growth may continue. And we'll consider this a minor correction. If it doesn't hold, then the decline could go down here. To the orange 200-week moving average. That's around 4,900 points at the moment. And finally, let's take a look at the daily candles. So as not to complicate things with any complex setups, I'll once again remove all drawing tools from the chart. Let's stretch the chart out and see what's here. Notice that again, a single daily candle has engulfed many days of growth. We also have a divergence here, but on a daily scale. Here it is. The highs are rising, but the RSI highs are falling. And there's a chance we could move into this zone, which, notice, we last entered back in April of this year. So a lot of things are pointing to the market going down. From this, we draw a conclusion. Based on the monthly candles, there is still no reason to open a short, but taking a long position would be categorically wrong. But according to the weekly and daily candles, this is a short. If you want to open a position, then from my point of view, the stop should be set above the high of this large red candle from October 10th. Its high was, well, in this case, we need to refer to the actual index, so we should open it up to check. And see what the high was back then, but you can set your stop above the high of the October 10th candle, or you need to set your stop there and you can try to open a short position. But again, we don't see any divergence on the weekly time frame, and usually declines are accompanied by them. Therefore, we cannot rule out another wave of growth with the formation of divergence on the weekly candles. And in that case, it will almost certainly be a short. Trade carefully. See you next time. The next review will probably be about gold. Goodbye.